Hey everybody out there, happy Monday. It is Kevin coming at you once again with Weeds Weekly Wrap, where we go over what happened this past week, what we can anticipate this week, some thoughts, and then a tip that could potentially help you with the spring buying season. So let's just dive right in. And what we saw this past week was really a net zero. The week became a total wash. From start to finish, did we have a bumpy ride? Yes, we did. We had a couple things that kind of laid that out, and we'll go over them really quick. Number one is we kind of rewound ourselves back to November of 2023. We went over our ceiling of 4.3% on that 10-year treasury, only to find by Friday, and that's why we had a net zero for the week, that the market rallied. We got below that ceiling. But again, due to the euro market, the euro bond market in particular, a great reminder that we are global. You know, so often we get tied into just what's going on with here in the U.S. economy. We talk about the Fed, what is our Federal Reserve going to do, but traders look at everything on a global. And it was a great reminder this week that, hey, they saw weakness in that market. It took our treasury market up over the ceiling threshold of 4.3%. And we rolled back to late November of 2023 to interest rates hovering around 7%. So no bueno on that. We are not looking for that, but it is exactly what we can anticipate for the several weeks coming up here. The one thing that I also want to point out is the jobs market is still showing growth, right? We saw recently that consumer spending is starting to come down. I anticipate that consumer spending is going to continue to dwindle, as well as consumer confidence as we keep heading in here with higher inflationary numbers. But the job market continues to be persistently positive. Now, we are seeing more layoffs, and I anticipate that to trickle down, but I think we're going to start seeing that number get corrected to where the Fed wants to see that towards the beginning of Q2, which is going to go right in line with what we thought as far as when the Fed is going to have its first Fed rates cut, which is going to be in the July meeting. So the ceiling remained intact this past week. And as we move forward into this coming week, we have a slew of data. However, as I've said before, all data is important, but the big boys are coming up. So I anticipate this week to be much like this past week. It's going to be a bumpy ride. I think it's going to be one where we're going to see the ceiling tested. We could potentially land a couple days above the ceiling threshold, pushing those rates up above 7. But I believe by Friday it's going to be coming back down. So if you are one where your client needs to lock this week because they're closing next week or the beginning of the following week, you want them to remind them to be in touch with their mortgage professional. You want to make sure that any dip they can take advantage of, because we did have those last week, and that dip can be anywhere from an eighth to a quarter point in an interest rate, which to your buyer is very significant. So you want to make sure that you're giving them that heads up. And again, we have a lot of data coming out this week, but nothing is super pressing, but I do believe it's going to be very volatile. So you're just going to have to kind of chug along here until we get into next week. So what is coming? Coming up next week, we have next Friday, which will be the 8th of March. We have our big jobs number, non-farm payrolls, unemployment rate. That is going to be, as I have said here before, as well as the following Tuesday, we get CPI. So they are clustered together coming up here in March. That is going to lay out the feel and the temp and where the Fed is going to be headed for the rest of 2024, right? Because once again, we are coming into this election. It is here in November. Once that cycle starts of all that advertising that's getting shoved down our throats, it's going to cause our clients to put brakes on. It's uncertainty. I don't feel comfortable. I don't want to do something. So again, these numbers coming out in March, fingers crossed, they are favorable to us, and it's going to move that pendulum back down to where we're on an average of 6.25 to 6.5 on that 30-year fix. And I think we're going to see a good spring then. We'll see things slow down as they typically over the summer, We then have an election, and then I think after the election is when I think we're going to see things really speed up, which is going to be great. So again, just expect this week and towards the beginning of next week, it's going to be a lot of ups and downs, a little bit of roller coaster. Like that roller coaster when you go to the amusement park and it's the old wood rickety one. It's not the big ones, so it's not the steep drops or the big inclines. It's that rickety wood coaster that you're just kind of moving around and you're getting jockeyed all over the damn place. It's uncomfortable, but it's not big spikes or deep declines. So that's what we can anticipate. The other thing I really wanted to point out is the real problem with inflation. And a lot of people, we're getting all the rhetoric from the media, we're getting rhetoric from the economists, we're getting all the rhetoric from any TV station you turn on, politicians. Hey, inflation's under control, inflation has been dropping, and so on and so forth. And that's all wonderful. And they're correct in the sense that, yeah, we're not seeing 9% inflation increases. So, congratulations, that's great. The problem is, as we go back, and we talked about it earlier, the first episode of this year, affordability is the big term for 2024. And the problem that you have with inflation is it doesn't go away. Unless you have deflation, right? Where you're going to see price corrections just get slashed because consumers are not consuming those goods or services. We don't have that right now. So inflation, wherever the prices have gone, they are going to remain fairly stable. And what that means, it's less money in the consumer's pocket, which is a problem. If you look at it last year too, the data just came out that for all of 2023, the average credit card interest rate was 22.8%. No shit. 22.8%. That is a huge unsustainable number. So again, I bring this up just simply because as we're trying to move our buyers off the sidelines, we want to be extremely conscious of the affordability. How many kids do they have? Potentially what are they doing for a living? These are going to be more difficult conversations that you as a real estate professional are going to have with your clients. You're going to have to start asking some of the harder questions. But the beauty of it is they're going to love you for it because they're going to know that you actually care as opposed to just saying, hey, taxes, insurance, and this is here. It's going to be more of a well-rounded conversation. You're going to get to know them better, their financial situation better. What are they struggling with? What's going on in their space so they don't get themselves and price themselves essentially out of the market of what they're looking for because rates could change quickly. And then you spin your wheels and you're not helping them and you're not helping yourself, right? And then the last thing, we heard about it a ton last year, especially with new builds. And I particularly focus on what is the existing marketplace doing, right? Because as a home builder and you're buying a big stretch of land and you refinance it at the low number, you have a lot of numbers to play with. So buy downs are probably pretty prevalent in that space. But as existing homeowners, I want to bring back talking about the 1 year buy down. And really quickly, my emphasis is trying to come up with creative ways that we as agents, people in the industry can talk to our potential sellers and say, hey, you're going to have a house coming on the market. We expect spring, obviously more listings to be out there. It's going to be obviously more competitive. And depending on the market that you're in, you're going to need to get a little bit more creative. And the 1-1 buy down is not super expensive. And what it does for the buyer, right, is it gets the potential buyer of your house down into the high fives right now, which is fantastic. And let's hope that data comes out in the first of March in our favor, and it's going to potentially get them into the mid fives, which is good for a year, which gets them into Q1, Q2 of 2025. And we absolutely anticipate at that time that rates will be down and they will have an opportunity to refinance, right? I mean, that's where everything is steering. It's just, I think the Fed and everybody in the economy just got a little bit over their skis and thinking things were going to happen faster. So once again, as you're talking to your potential sellers out there or clients that you already have on the market, as opposed to doing price reductions, I think marketing potential 1-1 buy downs, talking about what payments could be, talking about the monthly savings that could be the potential. And here's the cost to an actual seller. If you're selling a house for $2 million, assuming somebody puts 20% down, that's only going to cost you $12,624 to buy that rate down. If you're selling a $1.5 million house and somebody puts down the 20%, so they're financing $1.2 million, it's $9,468 one-time hit to you to buy that client's rate down. For $1 million purchase, $800,000 loan amount, it's $6,312. For a $750,000 purchase, which equals a $600,000 loan, you're talking $4,734, which is nothing, right, to sell your house. And for a $500,000 purchase, which is kind of the sweet spot right now, right? You're talking a $400,000 loan. It is $3,156 to buy that client's rate down to put your client, your listing in a favorable position. So those are the discussions you need to be having. Of course, if you need any help with those numbers, please don't hesitate to give me a call. I'm around as always, love crunching numbers, love spitting them out. Happy to do it for any client that is in the market today or down the line, they're just considering it. Everyone have a great week. Be blessed out there and happy selling.